Home Depot just issued a major warning and is one of the largest players in the home improvement as well as the new housing industry. We all need to pay attention to what that warning is from Home Depot. Okay, I'm going to go through a motley full article that talks about this. The title is Home Depot just delivered a warning to investor. Here's why the dividend stock remains a buy. Now, I'm not going to talk about the dividend side, but I think the article has a lot of information as far as what's going on in the economy, and that's something that we all need to know about. Okay, the first thing is Home Depot's growth has ground to a halt. Now, Home Depot is a great operator. So when their sales grind to a halt, it's likely something going on in the home improvement or the new housing industry, which impacts, has its tentacles throughout a large part of the economy. So let's see what the article has to say. Home Depot has been slowing for a variety of reasons. The COVID-19 pandemic pulled forward sales as consumers ramped up spending on do-it-yourself projects. Then came supply issues, inflation, and rising interest rates. Now, this is a fairly recent article that was published on March 1st, 2025. So this is not looking back in 2022 or something like that. This is recent. The article goes on to say, but this quarter, Home Depot broke a 2-year streak of declining same-store sales. So that's good news. It's a positive sign that the worst of the slowdown may be over. But the bad news is that Home Depot provides a bleak outlook for 2025 earnings for themselves. And the next thing the article talks about is a recovery is not around the corner. Home Depot expects comparable sales growth of just 1% in fiscal 2025. And if that's for comparable stores, and a 2.8% overall sales growth driven partly by the opening of what they think will be 13 new stores. Okay, so what if the recovery, what if what we're feeling now, what if the headwinds, what if the inflation that we're seeing, what if the consumer cutting back, what if the slowdown in the housing market, what if that's not around the corner, a recovery in that space? What do we do? Going to share more news, but first I want to talk about what you do. And what we do is we plan, right? We may have to adjust our plan. And I would encourage everybody to have a financial plan, whether you're 30 years from retirement, 30 months, or 30 days. It helps to have a financial plan because if we're not planning on where we're going, it's easy to end up anywhere. And we don't want to end up anywhere. We want to end up financially independent. And many people I would encourage you to work with a financial advisor. I think that's the best path for most people, preferably somebody that's a fiduciary to you 100% of the time. I know many of you are not going to do that. You're going to build your plan in Excel or Google Sheets or something like that. I'd urge you not to do that. It's just too easy to make a mistake. I had a friend that asked me to look over her plan recently, and it turned out that there was a mistake in one of the cells, and it's like, this number doesn't pass my sniff test. It doesn't feel right. And sure enough, there was a formula mistake. And it's just so easy for that to happen. So to avoid that, what I recommend is using software that's designed to help you create a financial plan. I like the software Bolden. It used to be called New Retirement. You can find a link if you want to support the channel in the description below. This video is not sponsored by them, but I am an affiliate. So a little bit of what you pay, and it's very affordable. It's about $100, as I record this, about $120 a year. So, okay, enough said on that. So so we talked about what to do, which is plan, right? And be able to adjust your plan, because sometimes you think, okay, I'm planning on this, but maybe we plan in a headwind. Maybe we say, you know what, I don't think the stock market returns are going to be that great for the next 12 months. We don't know. I'm not suggesting you change your asset allocation based on that, but it is okay to reflect it in your plan so you have an idea of what things look like going forward. Now, this is not new. This news from Home Depot, this recent warning is new, but I want to share with you a warning from from Home Depot's former CEO that was sent out towards summertime in 2024. This is I'm going to talk about an article from The Street. And the title is Former Home Depot CEO Issues a Stark Warning About the Economy. And they go on to say that this former CEO, Bob Nardelli, knows a thing or two about the cost of living and home improvement, and he sounded the alarm on several key numbers in late May of 2024. And what the former CEO is saying is the inflation pipeline has a long tail. I want you to think about that because it's important. It can be really difficult to tamper down inflation. One of the main indicators of what future inflation is going to be is what our expectations are for future inflation. Because when we have high expectations for future inflation, guess what? As employees, as workers for a company, we fight harder to get a bigger wage because most of us only get a raise once a year. And we know it'll be 12 months until we get another bite at the apple. And if we think inflation is going to be 5%, you better believe we're going to fight for at least 5%, hopefully more than that. So that's what Bob Nardelli says. It has a long tail. And he says, I'm seeing it across many, many areas, both with raw materials and you see it with labor for the reasons that I just said. He goes on to say, a 2-bedroom apartment in downtown Atlanta now goes for around $3,500 a month. And that's a couple $1,000s more from the post-pandemic period. So it's really depressing, he says, to see the impact on family net worth and income levels. Even though we've seen, he says, a 40% wage increase in some cases, it's been totally absorbed, my words, totally wiped out with inflation and the cost of living. He goes on to say this is a really devastating impact on the consumer today. And then he wraps up and he says, we're in for a rough time, I would say. And are we in for a rough time? I certainly hope that we're not in for a rough time. But, I've said earlier in other videos that trees don't grow to the moon as far as the stock market. The economy doesn't continue year after year after year, continuing to get better. There are hiccups along the way, and unfortunately, it's a feature of the world. It's a feature of economies that they expand for a while and then they contract for a while. It's a feature of the stock market that it goes up for a while and then it comes down for a while. Unfortunately, with the stock market, it tends to take the escalator up, so it takes a number of years to see that increase, but it tends to correct down quickly, which is why it's important, getting back to what I said earlier about planning. Make sure you have the right asset allocation, that asset allocation, what percent of your portfolios in stocks, what percent's in bonds, is correct for you. I do encourage you to look at your bonds, and instead of saying, how many years worth of high quality short duration bonds do I have? Instead of saying what percent, look at how many years, because that will give you solace if the market were to fall 20, 30, 40%, to be able to look at your bond portfolio and say, I don't have to sell any of my stocks for a number of years. So it's about making good decisions. If you like videos like this that are designed to help you make good decisions, it's not financial advice. I don't know your situation. But I do want to put things on your radar screen so you can make better decisions. And the YouTube algorithm says this is the next video of mine like that you should watch. Thanks for watching this one.